Hi, everybody. Welcome back to the 7 and 7 show. This is part 2 of my conversation with Sherman Williams. Sherman is the managing general partner of AIN Ventures and is a military veteran, graduated from the Naval Academy, did a number of tours overseas, served our country for over 7 years in the Navy, then went to business school, University of Chicago. We were classmates, and then transitioned into investment banking very successfully, and then later into venture capital. And now he runs AIN Ventures. And Sherman, talk just really briefly, just to recap for everybody, what does AIN focus on?
So AIN is a early stage investment fund that invests at the pre-seed and seed stage into companies that sit at the intersection of dual use and deep technology. Dual use means companies have both government and commercial application. Deep technology means companies that are building advanced technologies, advanced meaning their science and engineering advancements. These advanced technologies that are out of the R&D phase, but these technologies do not yet have wide-scale commercial adoption, okay? And those same technologies are assessed to be able to disrupt existing markets and or create branding markets. So within that, we invest specifically sustainability technology, life sciences, space technology, and AI ML dev tools. Those are our core focus areas for deep tech. And I don't want to conflate the two, but we also do invest in veteran-led startups. The reason why I say I do not want to conflate the two is because our deep technology companies do not need to be led by veterans. I repeat, they do not need to. But if we do anything outside of deep technology, it will be into a veteran-led startup because we believe these veterans come with unique leadership, determination, and grit attributes that make them wildly successful founders.
Perfect. That's a great recap. So in terms of what you're seeing in the venture ecosystem today, there's a lot of stuff going on. What's your take on where we're at today and where there's risks and opportunities?
We're in a pretty rough time for venture on a macro scale. I'll give you an overview. Pretty rough time for venture on a macro scale. For our specific investment areas, those dual use areas that have both government and commercial application, this is the best, this is the golden age. This is the best time ever since there was a robust venture community. Because, there was not necessarily, the last time there was geopolitical conflict on this scale that involved technology, military, economic, et cetera, was 1989, prior to the fall of the wall. And there was not necessarily, there was a venture market, but there was no robust venture market at that time, right? And we are now back into a true geopolitical conflict with, effectively with the Chinese, with the Russians also. And there is a robust venture market. There's a strong ecosystem. The tissues, the fibers that hold together the innovation ecosystem in the United States, to include venture capital, are extremely strong. And that ecosystem has a lot to give to the United States to stay ahead technologically and eventually economically in this, this kind of three-way battle against this three-way soft battle, not a kinetic battle, but three-way soft battle against the Chinese and the Russians.
So just to recap, you've got an amazing opportunity given your fund's focus, but outside of what you're doing at the broader level, there's a lot of challenges. So let's talk a little bit about the funding environment for companies that aren't in your.
So let me go back to that macro piece. I apologize. That macro area that is, struggling. It's actually highly correlated to what you do. What you're seeing is interest rates have gone up dramatically. And if you're an investor in debt, if you think about fixed income yield, you can make, right now I've heard people getting 15, 16% off of that, right? So when you have to think about where does that next marginal dollar go, do you want to take the risk of venture, or are you perfectly fine locking in a 15 or 16% yield? I think anyone is perfectly fine with investing in a 15 or 16% yield. I think a lot of venture investors are not. I mean, people are investing for the returns, but they are also investing to see for something deeper than just finance. The financial returns will come, but they're also investing to see innovation happen and technology move humanity forward. Innovation and technology move humanity forward. But if you're looking at it from a pure financial standpoint, a lot of people are saying, I'll take my 16% yield. And so as those interest rates have gone up, you've seen people slowly but surely go risk off, right? And taking a chance on things like venture capital. And that is what is causing a problem. It's tough to raise capital, number one. And the reason why, if you go underlying, it's easy to say it's just tough to raise capital. what is really happening is companies that are public and that are more risky, and as well as companies that are late stage growth equity style companies, are not getting the valuations that they actually seek, right? So that is an issue.
So from a high level standpoint, there's a lot of challenges in the VC ecosystem.
Mhm.
How would you elaborate on that?
Yeah, so those the challenges right now in the VC ecosystem are that when you really dig under the surface, companies, there are certain growth companies in the public markets, and there's typically a lag. You can pull the research, about a 6 to 9 month lag between down rounds in the public markets and down rounds in the private markets. Okay, and you're seeing that because you're seeing valuation compression in the public markets, those private companies that are consistently raising money in the private markets and getting marked and are not getting marked up to the degree that they once were. A lot of them have gotten marked down at the growth equity stage, or it's been flat, right? And so what you then have a situation is that that stuff rolls downhill, where the prices get cheaper and cheaper. So it's kind of like, hey, why am I investing at this level, at this valuation level? That doesn't make any sense to me, right? If I'm not going to get the markup, the subsequent markup that I would expect, right? That I had, let's say 24 or 36 months ago. So that's number one. The other thing is, like I said before, when it comes to investing in debt, you can get such high returns on debt right now. People are saying, hey, I'm willing to listen, I would love to get a 1,000% percent return on my investment, but it's hard to call if that's going to happen. I'm perfectly fine with the 15 or 16% return on my investment, right? I'm good to go there. I don't know this to be true. This is me. I do question how many people who invest in venture are either in a wealth preservation game or in a wealth creation game. And I think if you just bucket people and you put people in those two buckets, you'll start to get your answer about how they'll proceed in venture. Irrespective, I think those people will be involved in venture because the space has proven itself out. If you look at the S&P 500, look at the largest companies, the majority of, good chunk, not majority, but the good chunk of the technology companies venture back, right? So, but it's a situation where people are just being cautious for now. They've kind of pulled back to kind of take a wait and see approach, and that is affecting everyone from venture funds that are trying to raise fresh capital, and that subsequently affects the founders because it's a lot more competitive with respect to if you'll actually get capital from a fund, and then the valuation that you were seeking, which reflects back into your dilution that you take as a founder, is likely not where you want it to be. Right. Where was, it was not where it was, let's say 24, 36 months ago.
So let's recap. So essentially, valuations have fallen quite a bit. So we might be able to say that part of the pain now is because of the quote success that companies experienced in fundraising in 2021 and 22 to some extent, because valuations were so high, there was nowhere to go but down. And so now valuations are lower. So that's one factor. Another would be what you said about interest rates being up quite a bit. So now the risk-free rate is up substantially, and you can get 5.5% in a 6-month T-bill, and you can get 15 to 20% in pretty high quality debt product. I mean, you can get over 20% all in on venture debt right now with very low risk. And so a lot of people have been, from an allocation perspective, shifting out of what I'd call more speculative equity investments and moving into less risky credit investments in general.
Mm-hmm.
And so we've got a couple themes coalescing, and what that means for founders is that they're having trouble raising capital in the amount that they want at the valuation that they want and as quickly as they want. It's really like 3 strikes against them at this point. And so we've seen that across all stages, but I think it's most pronounced in later stage startups. Less so in the very early stage, which tend to be kind of immune because most of those companies are pre-revenue anyway, so they don't really fluctuate as much with the macro tide.
There is fluctuation in the smaller markets, But there's something that has occurred in the smaller markets, and this is another variable that needs to be introduced. It is that in 2020 and 2021, funds raised so much capital, and they have to put that capital to work. So at the early stages, you have so much capital still fighting for only so many good deals that naturally that creates a floor on the valuations for those earliest stages of companies. And that's yet another metric that needs to be considered.
Yeah, and that's great that you pointed out that mechanism, because that is why those valuations tend to stay higher even when there's a lot of macro stress. And
Yeah.
then the problem is for a lot of those companies is that then they don't have as many options when it comes to series, B and C and D, because that money is not flowing because those folks want to see more traction, and the money there can move more easily, right? If they don't like a middle market, growth equity deal, they can in venture, they can do something elsewhere with that money. And so there's less for there.
That's a great point to point out. That's a great point that I wouldn't even have brought up. That money can move much more easily. But I also think that when it comes to that, what the reaction that you're seeing at the early stage, because you're still seeing deals get done, the prices haven't come down as dramatically as you would think. But what you are seeing is that companies are very focused internally on path to profitability, because a lot of companies are saying there may not be a Series B forward. And I'm not even betting on a Series C for the foreseeable future until macroeconomic situations change. So that's what a lot of people are starting to think.
We've seen a lot of people extending runway. At least the smart startups and the smart VCs that back them are really keen on extending runway, improving liquidity, strengthening the balance sheet, and then to your point, getting to break even and profitability much more quickly. So there's a lot less focus now on growth at all costs and a much greater focus on, can we survive a deep recession? And let's build out now so that when this recession really hits, which it hasn't yet, we're ready for it. And what always is kind of crazy to me is that folks talk about how difficult it is now. Over the last 18 months, it's been very, very difficult for startups to raise capital. And a lot of startups are going under, including some very big name, quote, unicorns that are just, dying. Like last week, or maybe it was even this week, it was Convoy went under. They raised 260 bucks their last round, and they're a multi-billion-dollar company, and they're gone. And they have, so there's excellent companies that are just running out of runway, and cash is king. And I think a lot of folks are now really waking up to that reality that it's more about survival now than it is about how quickly you're growing. So that's one big theme we've seen, and we've also seen a lot of folks really hesitant to do down rounds. So they've got the ability to raise more capital, but they're trying to hold off on that because they don't want to issue more shares and sell more equity at a much lower valuation. And so they're trying to wait it out and wait for valuations to come back up. Unfortunately, I don't think that's happening anytime soon, because as you pointed out, the private markets follow the public markets and vice versa. It works in both directions, but generally private follows public, and public markets are still doing quite well. Although, September was not a great month. October hasn't been great, but the reality is shit hasn't hit the fan yet, and it will. And when it does, if public markets are down substantially, then of course private market valuations are going to be down substantially as well. And so I do think there's that risk that people are trying to bridge to a better environment, but they might be bridging to nowhere at this stage.
Yeah, they're bridging nowhere unless they get profitable.
Exactly.
Right. They're bridging nowhere unless they get profitable. Right. And for our specific area of deep tech, you don't really have those problems, because once that scientific or engineering, we don't really take scientific risk, but once that engineering risk is overcome, there's typically a market there, right? There's typically in our companies, the key characteristics are there's new science that has been done that hasn't been done before. The company has patents. The company has overcome engineering risk, or is working to overcome the engineering risk. And once that's overcome, there's a valuation step up. Now, I'm a pre-seed investor. My calculation is radically different than someone at the, let's say, my calculation is radically different than someone, let's say, at the Series B level, right? Because they need to be looking at the exit, et cetera. I mean, I think through that, but it's much. I'm still wondering. I'm still trying to usher the company along and overcoming certain hurdles, typically engineering hurdles, building out the team, initial go to market, et cetera.
So this is a good segue into my question about your investment principles and processes. What are the
Mhm.
key processes and principles that you live by?
So we are a bet the jockey, not the horse type fund. A lot of my principles, so, owed to University of Chicago, a lot of my principles were developed from learning there at University of Chicago. And then I've just seen it, and I've had the good fortune of seeing it 7 years in investment banking. People, in investment banking, you often look at the numbers, but it's typically just a rock star founder that is able to have, create wealth, right? And there are some founders, great technology, they're not necessarily rock star founders, right? Not necessarily rock star entrepreneurs. And so, what does that mean? Our investment decision boils down to three key items. Number one, quality of team. In this order. Number one, quality of team. And I will say the earlier the company, the further the way the company is from actually selling product, the more important the team becomes. Okay. Number two is size and growth of market. Because what you often see in deep technology companies is you'll invest in something where, or you'll be pitched on something where the market today is quite small. But in 10 years from now, 15, 20 years from now, this could be a massive, massive market. So you got to think about the growth of the market, not just the size of the market. And
Sherman,
a lot of venture investors make a mistake there where they say, I'm not investing here because this market is too small. When not considering the growth of the market.
quick question on that. What's your typical investment horizon, the time frame that you're looking to monetize this investment in?
So we have a 10-year life cycle fund. I want to do the majority of my investments in 3 years. So you're looking at about a 7-year harvest period. And what I'm trying to see is I'm trying to see significant markups in the company during that time.
Okay.
Yeah. And so the last key item that is involved in our investment process is technological differentiation. We invest in deep tech companies. That is important, but it's number three. It's not the most important. Number one is the team. Number two is size and growth of market. Number three is technological differentiation. And if it's not, if I'm investing in a veteran-led company that doesn't have deep technology, I'm looking for a unique go-to-market, unique relationships / partnerships. What we talked about in our last segment was people who've been in the box and they've got they've got some ideas as far as being out of the box. That's what I'm looking for.
How do you define deep tech for folks that don't know? Because it's a very broad term. What does that really mean?
Again, deep technology are companies that are building advanced technologies. So there's some sort of scientific and engineering advancement. Companies building advanced technologies that are out of the R&D phase, but those technologies do not yet have wide-scale commercial adoption. And those same technologies can the litmus test is that those same technologies can either disrupt an existing market or create a brand new market. And that is how we define deep technology.
So you would define AI as a deep technology.
Certain elements, 100% of AI are considered to be deep technology. We're looking at several now. Now, when it comes to AI, we look at AI ML dev tools. We look at things that make large language models better. A big area we've been looking at recently are domain adapted language models.
Say that one more time. I just want to make sure.
Domain adapted language models. A big issue with large language models, you have a lot of hallucinations. There are a lot of things that you do with large language models that it will give you the wrong answer every single time. And those are just anomalies in code, anomalies in the system, not just code, anomalies in the system. And domain, and they don't necessarily return the absolute best answer if you're, let's say, in a regulated industry like insurance or compliance or something along those lines. We've been looking at companies that have a much greater degree of accuracy when it comes to dealing with AI and ML, right? And so there's that. And then also companies that make life easier. They help prepare data. So make life easier for an AI or ML software engineer. and help them move faster so they can, more quickly apply their model to a set of data.
Feel like I talk about AI with everybody that comes on the podcast now because it's so topical. Are there pieces of advice that you would give to investors that want to be involved in AI, but also want to try to avoid some of that early mover risk? Because there's a lot of hype. I had Adrian Mendoza on a podcast a couple weeks ago from Mendoza Ventures in Boston, and he called it the second hype cycle of AI, where there's so much hype around it, and so people that aren't necessarily sophisticated and don't really understand AI or machine learning or its applications are just diving in because they're getting sold a bill of goods, essentially, right? I mean, they're getting sold snake oil by everybody out there saying, "Oh, we've got something in AI that's going to make you a bunch of money," and people are funding it. And the reality is probably 90 to 95% of those investments are going to be worthless. But I wanted to get your take on how an investor can invest without taking all that risk.
Well, in the early stages, no matter what, you're taking risks. So at some point, you have to accept certain level of risk, right? I really do think that. Like it's people over optimize for the wrong thing, right? Now, you have to accept some level of risk. But I like to let me do this a different way, and from a financial, and because I'm speaking to investors now, I believe that you need to focus on how do you underwrite an investment in a certain segment, whether it be AI or whatever happens, right? And there's a couple of things you need to do if you're underwriting an investment in any segment. You need to assess the founder, what's unique about them, the exact specific market. So you think about TAM, SAM, SOM, serviceable obtainable market. What's that exact initial market that they're building in? And are lessons learned from them attacking the serviceable obtainable market going to bear fruit as they go after the serviceable addressable market and then eventually the total addressable market later on in the company's life cycle? You need to think about that. And then you need to bring around technological experts that actually know what they're doing. They understand the tech. Be careful, they're not going to be able to assess necessarily the entrepreneur, but they will be able to assess the tech, right? Now for application layer AI, that's a little bit tougher because they're typically building something off the back of work that was already done with, let's say, at OpenAI or Bard or Claude or something along those lines. But for our area AI ML tools, I can go to academic experts. What we did at AIN is we formed a scientific advisory board of PhDs to help us look at tech from different segments, right? That's just a baseline, I think, of what you have to do if you're investing in areas like ours. You have to go out and talk to those experts. But remember, their data points are but one data point in the overall schema of the underwriting memo. And what the most important thing is, hey, I'm gonna give this person, a bunch of pizzas on the corner. Can they sell out? And, come back with empty boxes, and maybe even sell a darn box. And so, you have to assess whether or not the entrepreneur, and that a lot of that is pattern matching, right? Now there's some negative things that can happen with pattern matching. There's some negative consequences of pattern matching. You will only go after people that are like-minded, but we can get into this more. But that's why you want to have diverse people around the table with diverse thoughts, really diversity of thought around the table, so that you can surface people that other folks may have overlooked.
So going back to your comment about talking with LPs, you're successfully raising your fund, and that's going quite well. What are mistakes that you see LPs making in terms of investing in innovation?
How dare I assess LPs who are supposed to be giving me money? No, but the thing that I see is the issue I have is, as a deep tech investor, I've literally had LPs say, I don't understand your space, I'm not going to invest, right? Makes sense, actually. If you don't understand, then you should not invest. But then why does your ecosystem not have anyone around it? Like, why are you not able to tap into someone that can help you diligence that investment? Because the internet was a category, in the mid-90s It was, we invest in the internet, right? Like, what is that, right? And some there may be some venture investors we don't really do that. That doesn't make any sense. We don't do it. Well, then you're going to miss out on a whole segment that's going to revolutionize the world. Um, Folks that saying they didn't necessarily invest in social media, right? Well, those are some of the biggest companies that were built. People, there was a tremendous wealth creation from that, right? And they're going to be penalized for not going into that segment. So I think that here's the reality. It's all about incentives. Like, bring it back to University of Chicago. It's all about alignment of incentives. If they do, a lot of these LPs don't necessarily, if they take a bet on a fund one and that fund doesn't work out, that could be fireable. Fireable situation, fireable offense. If they do take a bet on a tried and true VC that's on fund 5 or 6 or 10 or whatever, and that VC doesn't work out, that was just a bad one, right? So a lot of LPs are not incentivized to invest in the early stage managers that are finding the next crop of things. And we have this empirical evidence that first time funds outperform other funds, right? So I think that is a complaint that I have, and that is an issue. That's why I'm actually an LP in the fund myself. And I think for the rest of my life, I want to meet, extremely thoughtful, data informed, with unique perspective, young people, and I want to invest in their fund going forward. So I think that from a actual underwriting standpoint, there's misalignment of incentives for a lot of LPs, and I think that becomes an issue. But I'm not complaining whatsoever. Not complaining. If this gets clipped up in the sound bites, I am not complaining. I think it just kind of is what it is. But that's why you want to pay it forward, right? As a fund manager, when you meet unique, newer funds, you want to put some money to work into those folks because you knew how it was. You knew that a lot of LPs are just going to miss it because they're not necessarily at the bleeding edge of innovation. Some of those LPs, right? No fault of their own. Everyone has their own their task and their job to serve, a job to do, I should say. So.
I think a lot of people just want to bet on the race after it's been run, and that's just not feasible, And so I think there's, I've talked to, 1,500 prospective LPs, probably more than that over the last couple of years. And, most are just not going to be early movers, certainly not first movers. And that's okay. I mean, there's folks that make a lot of money by being early movers, right? And there's folks that make less money by not being early movers.
Yeah.
But I think, it all goes back to one's personal incentive structure, like you said. I mean, that's rule number one in business, is understand the incentive structure of the person sitting across from you. And that'll dictate how to handle the situation.
Yeah. I mean, there's some LPs, I'll have a conversation with them, but I know they're in a tough place too. And listen, I'm not complaining, because if I were in their position, I may also choose like they choose. Now, I will say that I am trying to be. I love innovation. I'm truly in love with innovation, right? And I do love newer technology. So I wouldn't necessarily put myself in their shoes, but if I were in their shoes, who am I to say that I wouldn't make the same choice? It's like, let me go do Sequoia fund, whatever. Or let me do this guy that spun out of this fund or whatever have you, because it makes a little bit more sense than first time fund manager. Maybe they have a bunch of investments, angel investments here and there, but not exactly sure. I'm not willing to take that level of risk, and they end up waiting. And there's actual consequences for that. There's a loss of value creation relative to if they would have got in earlier with that GP.
Yeah, I think that a lot of folks think it's an all or nothing decision, and so they don't necessarily want to take a big bet on an early fund or a fund strategy that they don't necessarily understand. That's something like deep tech, for instance. And they also don't want to have too many line items. That's a common refrain that I hear. People say, "Hey, I like XYZ idea, but I've already got 100 LP commitments out, and I don't want any more."
That is a super fair, and that is a legit decision by the LPs that I think makes sense. with LPs, I mean, you hear from a lot of LPs, we don't have any room for more managers. Hey, man, it is what it is. And they're right. I mean, they can't just have that many managers. It's just the issue. It's just a situation. But here's the thing, and this is why I'm not complaining. I feel, listen, the, I learned this, playing football growing up, being in the military, being an investment banker. You can do everything right and still not win. But that's why you play the game. If you knew you were going to win, then what's the point, right? That's what's exciting. You can have all the right people on your team, et cetera, et cetera. You still don't win, right? And so you got to play the game. You got to take the risk. Historical performance is no indication of future performance.
Yeah, I mean,
right?
I would say that it's not wildly risky, but it's riskier than investing in 6-month treasury bills. Like, I mean,
100%.
like,
yeah.
I mean, I mean, one of the things you have to do as an investor is diversify, right? And I think a lot of aren't as diversified as they think. They think of venture as like one category, and they might pick like one manager within that category. And to me, that's laughable because there's so many different flavors of innovation investing. And I've talked about this, many, many times, so I won't rehash it, but suffice it to say, the smartest thing an investor can do if they want to make money is invest in innovation, but across multiple products and debt and equity at different stages. You want to have a diversification within that innovation pool, if you will.
I could not agree more. I could not agree more. Venture debt plays a massive role in the innovation ecosystem. It should play a massive role in the innovation ecosystem. Right?
How do you think about venture debt as from a founder's perspective? Like when you think about portfolio companies and as they grow, how should they be thinking about venture debt?
I think venture debt is a great solution to top up as a complement to equity. It is a great item to use in order to top up in the context of not taking additional dilution as a founder or for your earlier investors, right? I do think it's a great solution. I think all venture debt was not created equal. Companies were not created equal to be able to take on venture debt. In my specific space of dual use tech, where companies will at times, not across the board, will at times get government contracts. Although it's very difficult to do, but when they do it, I mean, that contract being fulfilled is, for lack of a better term, effectively backed by the full faith and credit of the United States government, right? And so you want to bet, like Warren Buffett says, when in doubt, bet on the United States government, bet on the United States system. We've got a lot of issues. We got a lot of fraying right now. There's a lot of crazy stuff going on. We don't have an active House. We don't, House that can actually pass bills right now. But I do think that we will get it together. I'm optimistic. I'm a venture investor. I'm naturally optimistic. I believe we will get it together. And you're at some point, at certain levels, you're like, for us, if I have a company that goes get $20-30 million actual contract revenue, program of record revenue with the federal government, there should be a factoring / debt situation for a company like that.
Yeah, right on. I mean, that's the perfect type of company that should be utilizing debt because they've got recurring revenue that's going to come in with very, very high probability. And therefore, they should raise as little equity as possible and leverage the company as much as possible. And ultimately reduce that dilution to the founders and to the existing shareholders.
Yeah, I agree.
The other thing I wanted to ask you about is in terms of reducing the need for down rounds, the role that debt plays in that equation.
Yeah, I mean, if you're trying to raise a certain amount of capital and you're not able to get there without effectively taking on a down round, venture debt is a nice supplement there. But my view on down rounds is, particularly for deep tech, is not at some point, guys, what are we trying to do? At some point, you have to say, hey, I'm not going to win this marathon. Let me just finish this darn thing. Right? Like, I'm not coming number one in this marathon, but let me finish. I've run numerous marathons, right? And I had one I ran back in 2018. I had something basically go wrong. Injury popped up, cramps popped up really, really bad. It was a 30-degree temperature difference from where I trained, and it just became a intestinal fortitude exercise, right? And you owe it. No, yeah, you do owe it. I mean, when you employ people and you have hundreds of people working for you, even if you have to take a down round, look what Instacart did. They reset the stock options, took a down round, reset the stock option prices, et cetera. Like, that is the right thing to do, right? And let's live to fight yet another day. And let's try to make it happen and let get the next private raise, or let's try to make it happen in the public markets, right? I think that you have to be realistic, particularly if you're a founder. And look, there was a cost basis. People say there's no cost basis. No, there's opportunity costs because you did something else. There's life costs, like your life that you just overtaking you, right? I had a founder, he hit me up. I was texting with yesterday. He was saying, "Hey man, I'm trying to get to the next round, but people are buzzing around me selling." And I said, "Listen, you need to take a real look in the mirror, figure out if you have the energy to keep going, and if not, any inkling of doubt, sell." I'm not going to give you a pep talk, because at the end of the day, you are the man in the arena. You got to be in it yourself. I can be, behind the ropes, but I'm not in that fight with you, right? So you need to know if you're willing to keep going, and that's kind of the mental dynamics. And I just mentioned the financial dynamics that involve these down rounds. Venture debt, yes, is a nice supplement to mitigate that to some degree. But hey, if you do have to take a down round, and that's the way the market is pricing things, it is what it is. Just stay alive.
You're right on, and there's nothing you can do about it. I mean, the market is the market.
Go find another buyer.
Yeah.
Yeah, you can go find another buyer. Yeah, it's really simple.
So, staying with this theme of founders, yesterday we talked about the keys, or it wasn't yesterday, but earlier when we had our conversation, we talked about leadership, persistence, and grit as three things that you look for, and that also military veterans tend to have. What are some other pieces of advice that you would give to founders right now that are maybe struggling raising capital, aren't happy with their valuations, haven't seen the traction they want because maybe certain aspects of the economy aren't going their way? What would you say to them?
Something that was said, another booth lesson learned: get out there and pitch. Don't hold things too close to the chest. Be sensible, but don't hold things too close to the chest. Get that MVP out there as fast as humanly possible. If you're going up the TRL scale, your deep tech company, start developing partnerships, floating with people who could potentially use your product. Start floating it by them and getting their feedback absolutely immediate. Like, start that clock as fast as humanly possible. So that's something that I think that founders need to do. The other thing too is that founder market fit is something I've learned from working with the Techstars organization, helping out companies there. Founder market fit is huge. Look around and say, do I have the absolute best team to execute on this? Right? I'll bring it home, my own fund. Do we have the absolute best team to execute on our investment thesis? I think we're decent, but have we peaked? Hell no. We're trying to surround ourselves with much better people. We want to look back 5 years from now and like, ew, what was this? We were not hitting on the level we needed to be, right? This is just, it's night and day. So consistently up-leveling your team, because a big thing for founders when you think about founder market fit, besides you getting a product in the market, which is that's king, right? That's the big joker, right? But besides that, you have to think about one thing we look for: are you able to recruit top tier people to your company? People to leave, bypass an opportunity to go do something else, right? To join you on your crazy endeavor. That is something that we think about heavily and we look for. Who are you able to surround yourself with? And that's free, because you try to convince them to work for free, work with you or for you for free initially. Even if they only work for you 10 hours a week and they're going to come on full time upon full raise, right? Like, who are you able to get into your circle? That's something else that's really important, and advice I'll have for founders. And then all this signaling is cool story, but the brass tacks is revenue. Are you able to generate revenue? Period, full stop. Some people are hustlers. Some people just know how to make it happen, right? And you need to be that you need to be that, right? You need to be that some people, I should say, right? You need to figure out a way to generate a dollar. And like for our deep tech companies, going every company, I'm like, I don't harp on the SIPR process because there's a lot of issues with the SIPR process, tremendous issues. We actually have run a study before a couple of years ago. There was actually a negative correlation between your company's successful raising venture capital funding and going out and getting massive amounts of SIPRs, right? We actually run that study, right? There's a negative correlation. But, you know, if you need grant to keep going, be scrappy, go get it, right? It's the most attractive thing is seeing you do a lot with no money raised, and then the money just flows. I have a friend, Frederick Grocer. He actually started Black VC organization. He has a great quote that he says, "Do the work before you do the work." When they come to you saying, "Are you qualified or is this good enough?" We're already doing it. What are we talking about right now? You know, we figured it out. We found a way to bootstrap friends and family, and I get it. Not everyone has the friends and family to put $1 billion. I've seen people raise $10,000 from friends and family, and I've seen people raise two. I actually met a company that raised like $7 million friends and family. Like, who are friends and family? Can I be in the network? Right? And so like you really need to be as scrappy as possible.
The theme you hit on there that really resonates with me is resourcefulness. One thing I can't stand is when somebody needs to do something and they say, I've never done this before, as if that's a reason that they can't do it in the future. It absolutely drives me up a wall. My response is, I will figure out how to do that, and I will
100%.
do whatever it takes, and I will nail it, and I will never make the same mistake twice.
We have a saying, and I've said it on other podcasts, we have a saying in the Navy. I don't know if they do it in the other services. It's called Message to Garcia. You can Google it, look it up, and basically means figure it the F out.
Yep.
Figure it the F out. And listen, I don't say this from a position of privilege. I do have privilege. I acknowledge I have some privilege in life. But I'm trying to say this without privilege involved. You know, I acknowledge there's some level of privilege that I do have. But you know, you have to figure it out. There are so many things that I want to do with our fund, AIN. Things I want to add to what we do. We don't have the money for it, but I'm figuring it out. I got people working for free, basically, right? With the promise of something later, right? Or just help me out a couple hours a day, a couple hours a week, I'm sorry, or whatever have you, right? When you figure it out, and I trade some sort of economic event down the line in the future for that, right? I'm doing what I have to do. I'm in the fight too as a startup fund manager. This is a startup. I will say a founder of a company, their job is, you know, my job from difficulty is a 9. My difficulty level is a 9. But that's on a scale of 1 in 99 relative to a founder. A founder's job is much, much harder. And I think that's because of the idiosyncratic risk of you taking individual risk on that company, whereas I'm spreading spreading investments along multiple companies, right? And I'm fully aware that I'm not in there in the fight every day with the founder. I try to be as helpful as possible. I'm an assistant, right? But I'm not in there pounding the pavement for sales, et cetera, et cetera. I'm pounding the pavement my own way, but it's not the same way. And what the founder does is much harder than what a venture fund is, in my personal opinion.
You're adding value outside of just capital.
100%. 100%. We focus on it heavily. We run a syndicate, Academy Investment Network syndicate. It's made up of hundreds now, like over I think 500 or 600 Service Academy graduates that we selectively reach out to some of them and say, hey, can you help this company? Can you help this company in some way, shape, or form? So yeah, we definitely that's part, and that's a core component of our network. Our network is much bigger than just those academy grads, right? That are within our syndicate. But we're definitely trying to provide more than just capital to these companies.
We're just about out of time. I wanted to ask you about themes that are going to be relevant for founders and VCs and also LPs in the space over the next 3 to 5 years. Like, what are the big things that everybody should be thinking about?
I have several things. So I think that we are in a paradigm, we're experiencing a technological paradigm shift that's been kind of slowly coming, but it's actually can be brought to the real world for your average person to experience it. And you're seeing that with artificial intelligence. You're seeing that with synthetic biology. You're seeing that with in the telecom space with folks like Starlink and Amazon. They just put up 2 Kuiper satellites. They're putting up their satellite network. I mean, there's a fellow investor, Seraphim. I think they've invested in not all for telecom, but they've invested in 10 different satellite constellations. I think I heard them say at one event, right? So you're starting to see, you're going to see that affect real life, right? And so I think if you want to be part of the wealth creation story for the next 20, 30 years, you want to get ahead of that. And shameless plug, you want to talk to us, right? But us and there's several other funds that are deep tech funds that are great that you want to talk to that are kind of pushing on that technological shift, right? I think another theme is we don't do this, but living in New York City and spending a lot of time in LA and San Francisco, I think you're just starting to see a shift in how people work and live. That kind of future work concept. There's a whole ecosystem of companies that are going to be born to best support that shift, right? Because people are saying, I'm not going into the office to go punch a clock 5 days a week for a lot of jobs. Some jobs you have no choice. In our companies, deep tech companies, you got to build something in real life. It is, you got to go punch a clock, right? You got to go build, right? But I'm saying outside of what we do, there's a massive shift that's occurring there that I think a lot of people that is oncoming and folks need to get ahead of. If you're a founder, want to think about founding a company, you can support that space. If you're LP, thinking about backing a fund, I would look at some of the future work funds. I have several in my network that I'm happy to introduce you to that are fundraising. Another thing is from a healthcare standpoint, synthetic biology and the offshoots of that are going to have revolutionary changes to the human body and how long we're able to live, right? My father, just had a health issue that 5 years ago, there wasn't much they could do. And he's completely overcome it because of modern medicine and things that are now, and he didn't go to a research hospital, he went to a community hospital. And for the procedure that he had, the diagnostic procedure that he had to identify the issues, just started getting covered by CMS last year. If this was 2 years ago, it wouldn't have been covered, and it would have been, we would have to scrape together money to be able to support it, right? To be able to get that, right? He would have to switch hospitals, all this other stuff, right? And so that synthetic biology revolution, and not only synthetic biology revolution, also the digital health revolution, the persistent surveillance of human health is going to revolutionize how humans live, work, act, etc. And that's going to result in us living longer for the people that do listen, right? It's going to be natural selection. People that don't listen, they'll die earlier. People that do listen, will be fine. The other thing.
Sorry to interrupt, but I just want to comment on that briefly. It's funny because you and I live in bubbles in a sense, because I'm in LA, in Santa Monica, and so the people that I hang out with are all like elite, athletes, typically at like Gold's Gym in Venice. I see Arnold Schwarzenegger there, 4 days a week, and I see the world's leading Instagram folks and a bunch of NFL and NBA and ex-pro athletes come in, and they're all in phenomenal shape, right? And they're all doing this monitoring of their health in all kinds of ways that did not exist before. Like if you watch some of the training that goes on in like the NFL or NBA now, there you go, right? If you watch some of the stuff that they even have on TV on like Netflix, and you see how folks are training. I was talking about this the other day with one of my buddies who played in the NFL for a long time, and he's like, man, if we had this when we were growing up, 25 years ago, it would have been a completely different story, right? I mean, granted, the competition would have been better too, but
they would have had to access the same tools. Yeah.
But to your point, not everybody accesses them. So what I think is really interesting right now is you've got these tools and training techniques that are beyond the scope of anything we probably could have even imagined, even just a couple of years ago. And yet, if you look at broader statistics of the US population, like people are more obese now than ever before. They're actually, I think average life expectancy is declining now for certain people and groups of the population, which is mind-boggling to me. So clearly
we do live in bubbles. I do think that one of the big things what happens when you come out with a different treatment for patients, because you have to think about typically, I think Medicare and Medicaid cover about 30-some-odd% of the population. So you have to, so there's 60-some-odd% that's not covered, right? And private insurance, and some people just don't have coverage, right? But it's very small because of Affordable Care Act. Very few people do not have coverage, and so you really have to think about the cost to the system. There's insurance products that can be created if you're not taking advantage of these tools, right? And you are living a lifestyle where you're eating or not working yourself out into obesity, right? So I think that revolution is coming. And remember, you're talking about how people are today. As a venture investor who's optimistic, I'm thinking about 10, 15, 20 years down the line, right? I'm already thinking about fund one. We got multiple life science investments in this current fund already, but I'm already thinking about fund two and lining up the pipeline for that, right? Even and so there's a lot to happen there. I think that the other massive gain. So I mentioned AI, talked about space a little bit. I talked about life sciences. I think that one of the greatest wealth creation opportunities in our lifetime is the energy transition from fossil fuels to effectively electrification, the ability to harness. First law of thermodynamics is energy can neither be created nor destroyed. So harnessing energy, right, and then being able to store said energy. I think it's going to take some time. I personally think that fossil fuels are still going to play a part in this 30, 40 years from now. Coal's still going to play a part a little bit. It will shrink, and so fossil fuels will shrink. They're still going to play a part. But at the end of the day, this energy transition is going to happen, and it is coming. And particularly if there's a family office listening, and you can have like a 20 or 30 year kind of viewpoint, or if you're an endowment fund or something along those lines, like there is tremendous wealth creation that will occur because of the energy transition. Here's the thing: it's not about just being green anymore. We're getting to the point, the inflection point, where some of the renewables are cheaper than pulling fossil fuels out there, right, and shipping it somewhere, right, and then once energy storage truly improves, it's going to take some time, a lot of battery technologies, ultra capacitors, et cetera. Like it's going to make economic sense. And people may scoff up, won't be in the next 5 years, yeah, but it'll be in 10 years, right? And you ask anybody on this call, do you want to be here 10 years from now? And you want to be able to clip some yield off of one of your investments you made in 2023? Absolutely, right? Absolutely. We all think we're going to be here 10 years from now, right? So 15 years from now, 20 years from now, 30 years from now. So those are some of the areas. I talk my book a little bit because those are the areas we invest in, but I think those are some of the areas that are ripe for massive disruption. And because of that, there's tremendous wealth creation that can be gained there. Now, the one unique aspect of those technologies that did not exist with the software revolution of the 90s and the 2000s, the early 2000s, is that each of those issues I mentioned are national security issues. That is a massive difference that people have not wrapped their heads around. And in our fund, we have a thought leadership section on our website, ainventures.com, where we address that. The energy transition, that's a national security issue. You know, I have some of the leading green initiatives in the United States, the Department of Defense, right? What's the largest logistics agency in the world? Defense Logistics Agency, right? You think about space. Where does all the money for space come from? United States government. Has anyone who's listening to this, have you used Google Maps or Waze or whatever have you in the last week or two? That's your taxpayer dollars went into you being able to use it, right? Because you're using GPS. A lot of synthetic biology when it comes to being able to do diagnostics, assess rapid pathogens, healthcare surveillance for potential pandemic, like outbreaks. That was the government. We all have shots in our arm because of Operation Warp Speed, right? So like, and that saved millions of lives. Even you can be an anti-vaxxer in the sense of I'm healthy, why do I need the vaccine? Cool story. But 80, 90-year-old people needed it. And their lives were saved. Now the people on the fringe won't even believe that. We can discuss that another day, right? But the involvement of the government and governments around the world and the technologies that are going to define the 2020s through the 2050s and 60s, a lot of them are backed by the government directly. Software was backed indirectly, right? Someone had to give grants, et cetera, for the fiber optic cable. The government created ARPANET, right? I mean, a lot of that stuff was done by the government originally, but it was indirect. It took quite some time. Where a lot of this stuff is you're going to see direct benefits.
Yeah, that's why I love your thesis of investing in dual use technologies and also investing in veterans that have better access to a lot of those dual use technologies.
Yes.
And a better understanding of the market in many places as well.
Yes. Yeah.
That's a winning thesis. I mean, we definitely agree with that at ARI. I mean, it's part of our thesis as well in terms of sectors that we look at and that we like, and types of founders that we want to back. So it's two big green check marks, right?
Yeah.
Dual use, veteran founders, win.
Yep. And also for our companies that do get contract eventually, not everyone's going to be a winner, but the companies that do eventually get contract revenue with the government, those are great venture candidates upon their next raise.
Yeah, I mean, that's kind of like one of our sweet spots, right? That we really want to get deeply involved in is funding veterans and dual use technology companies that have reached that post revenue stage, and now they've got sticky revenues, whether it's from the government or from some other customers. It's really all about just having proven themselves, and now they've already been largely de-risked, and the founders are really keen to maintain as much equity in the company as they can, reduce their cost of capital, shore up their liquidity, extend their runway. So it's basically a win for everybody. They get cheaper funding, they get more funding. We get a really solid investment that's going to produce a very attractive low risk return for our investors, and everybody wins. And honestly, that's the way investing should be. I think that's gotten away from that in the last couple of years, or maybe it's always been like this, but it seems to me like there's so many folks that are just out there trying to make a quick buck, but they're not thinking about the long-term value they're adding for their customers. I look at I hate to harp on it, but I just can't stand some of these newfangled investments that we've seen over the last couple of years, cryptocurrencies they're not even real, right? And it's just like, look, you're going to make a lot of money as the producer of that initially, because you're going to sell it to somebody that doesn't really know what they're getting into. But I think there needs to be a rebound or a kind of ricochet back to investing that benefits all parties involved.
Yes.
Right?
Well, the markets will often do that for you. And you're right, people, folks like with crypto and some of the other, and I'm not hating on crypto. I mean, I actually believe in Web3, certain elements of Web3 vigorously. I do. But I do believe that it had a crazy hype cycle. Things got out of hand, and the market will tell you, and the market did tell that community. I think there are certain elements of defense tech that are too much hype, right? And the market will speak, right? But that's why you have to have some sort of underwriting capability. And if you're in venture, this is a slow way to make money. Okay, so you have to have. I mean, when I look at an investment in 2023, I'm trying to assess what the future will be in 2033. Because of QSBS and how early we invest, I don't even give a darn before 2028. I want to sit on it for 5 years, right? So I can get the benefits of QSBS, Qualified Small Business Stock Tax Treaty, right? And, so, so like, I mean, you have to take a long view, and a lot of times, those folks, the market will take care of those people.
That's where venture debt differs quite substantially from venture equity, especially at the seed stage, in the sense that our time frame is not nearly as long. So you're looking out at 10-year horizon. We don't need to do that. We just need to know, is this company going to repay its loan? And that's what makes it a lot easier for us, quite honestly. It's not nearly as hard to look out 2 years as it is to look out 10. I have no idea what the world's going to look like in 10 years. I'll tell you that. I have no idea. But I can also tell you this.
Call me.
I've been damn good, Sherman, at pegging where the market's going over 2-year horizons for the last 20 years. And I've pretty much nailed every big theme of the last 20 years, including the venture debt theme that we're seeing right now. And so I'm very confident in my ability to make great investments with a 2 to 3 year forward-looking period. And that's why venture debt's a great complement to venture equity as an investor too. So not just as a founder that wants to diversify their cap table, but as an investor in innovation, you want to have some longer maturity type investments that are maybe a 10 or 15 year life cycle, like a seed stage fund. But then you also want to sometimes get paid to wait. And that's basically what I tell our LPs. You're going to make your 15% every year, and you're going to have equity kickers on the deals. So if the companies do go public or exit, and the valuations are attractive, you're going to make a lot of money on the equity side as well. And my view is don't have one or the other, but have a little bit of all of them, right? And then you can kind of allocate based on your risk preferences and your timeline. Like I said this on a previous podcast, I've had investors say that they really like venture debt because they want to be alive to harvest the investment. I mean, I'm part of a big angel syndicate out here in LA called Pet Coast Angels, which is the biggest angel syndicate in the world. And there's many investors that have said, hey, I got to stop angel investing because I'm literally going to be dead before these investments make me any money. So I'm starting to move out of angel investing into venture debt, for instance, because I can actually earn some money while I'm still alive. And so it's I think
tell them to build a trust. Tell them to establish a trust too.
Oh, these guys do. I mean, these guys.
The money can go to them.
Yeah, these guys. They're very successful. They used to run a number of big public companies that you would know well. So anyhow, it's been great having you on today.
Absolutely. Really value, my pleasure, man.
Value having you on, value your time and thoughts, and anything you want to leave us with in terms of parting thoughts and best ways to get in touch with you.
Yes. So parting thoughts, just keep building despite the noise, despite the chaos. Keep building, create the future you want to see. Hopefully it's a good one. But create a future that you want to see that's authentic to you. You can get in touch with me via our website, ainventures.com. We have a portal where people can submit their decks, etc. I'll even give out my email, Sherman@academyinvestor.com. Sherman@academyinvestor.com. Not afraid to get on my email. I get blown up, but somehow I find a way to get to 0 inbox. And yeah, I mean, this is outstanding. I love talking about the future. I want to backtrack on something I said. You said talk about the future. I said call me. I want to say that I don't know what the future will look like, but I think about it I think about it all. I make it my job to think about it, and I'm betting on companies that I think will play a massively key role in what the future will look like. And so always happy to talk about that. I want to throw a shout out to, because we have some product coming out. We often at our fund publish thought leadership work. So if you want to have follow up, and we're very data informed, we have more coming out along those lines for our fund, but we're very data informed investors. And as we post stuff, please, from time to time, look at our website, ainventures.com, in the thought leadership section, and you can see some of the thought leadership work that we be consistently putting out. And thank you.
I've read some of it and I think it's great. So yeah, I encourage people to look at that for sure. Yeah. Thanks, I said this previously. I think people who read are going to have a huge competitive advantage. And then people who read good stuff by smart people are going to have an even bigger. I mean, just reading your stuff and the thought leadership of others like you is going to put investors in that top 1%.
Absolutely.
That's the answer. There's no tricks here.
And that's for people who don't invest in funds and they say they want to do their own thing and go direct. We consistently have deals that are coming up. We do SPVs all the time. We should talk there also. There may be some a la carte one-off things that we have unique access to. You may want to do. Talk to us. We have a theme and a thesis, right? It's all out there for you to see. You can read it on our website. We'll send you the investment, right, from when we first invested. You can just say, yeah, I agree or I don't agree, right? But let's talk.
Good stuff. Well, thanks again for coming on, Sherman, and thanks
Absolutely.
everybody for listening to the 7 and 7 show with Zack Ellison. See you next
Thank
time.
you.